Good day, my honorable lecturer, Dr. Farid Ashraf. In this video presentation, we would like to discuss and explore key drivers behind the recent financial performance of Eastern Oriental Bhd and FCW Holdings Bhd in the year 2023.
Good day everyone, my name is ESHAPREET. My matrix number is 297963. Today I will be enlightening you about our company's profile. Our companies are Eastern and Oriental Bhd and FCW Holding Bhd. Eastern and Oriental Bhd, or also known as E&O, is a premier lifestyle property developer listed on Bursa Malaysia. The E&O name is synonymous with creating pacemaking addresses of enduring value. Its profile spans of hospitality through to luxury living, headlined by Penang's globally renowned hotel. E&O activities are driven by four growth engines in Kuala Lumpur, Penang, Johor Iskandar Puteri, and Central London. Next, I will explain about FCW Holding Bhd. FCW incorporated on November 28, 1957. The company is listed on Bursa Malaysia Securities Bhd on main board, or also known as the main market, on August 17, 1957. The company's two main businesses are holding investment and offering management service. The company subsidies and associates are involved in the businesses of property development, contract manufacturing, and wholesaler of cosmetic, toiletries, and household products.
Good day, my lecturer. My name is Ningrum Melati Lestari. My metric number is 282725. In this presentation, I elaborate the calculation of financial ratio.
Liquidity ratios determine companies' ability to cover short-term obligation and cash flows. It is used to determine a debtor's ability to pay off current debt obligations without raising external capital.
First one, A, current ratio. It measures the company's ability to pay off its current liabilities within 1 year with its total current assets such as cash, inventories, and account receivable. Current ratio can be calculated by dividing current liabilities from current assets. Measures the company's ability to pay its current liabilities without needing to sell inventories or obtaining additional financing. The formula is quick assets divided by current liabilities. Meanwhile, the quick assets equal to current assets minus inventories.
Secondly, activity ratio describes any type of financial metric that helps investors and research analysts gauge how efficiently a company uses its assets to generate revenues and cash.
A, total asset turnover. It measures of an efficiency a company using its current assets to generate sales or revenues. It's sometimes used to compare similar companies from the same industry or group. The formula is net sales divided by average total assets. A, total asset called receivable turnover. It's utilized to measure how efficient a company collecting receivable from its clients, and the formula is net sales divided by average trade receivable.
Thirdly, profitability ratio indicates how efficiently a company generates profit and value for shareholders.
It measures how a company makes money. It is used by lenders, investors, and business themselves as an indicator of company's financial health. It can be obtained by dividing net sales from net income. It measures its return that investor may receive from their investment. It can be calculated by net income minus preferred dividend divided by average common shareholders' equity.
The last one is leverage ratio. Assess the ability of a company to meet its financial obligations. Banks have regulatory oversight on the level of leverage they can hold.
It measures company's ability to pay its current liabilities with its most liquid assets. It measure can be calculated by dividing total assets from total liabilities. Can be calculated by dividing total assets from total liabilities. Can be calculated by dividing total assets from total liabilities. Can be compares a company total liabilities with its shareholders' equity and to measure the change of a company's reliance on debt over time. It can be calculated by dividing shareholders' equity from total debts.
We will go with the first one, which is the current ratio. When a current ratio greater than 1, indicates that the company can cover its liabilities using its current assets. As for company FCW Holdings, it has a current ratio of 8.2. It means that for every 1 ringgit of current liability, the company has 8 ringgit 20 cents in current assets. The next one is quick ratio. FCW Holdings has 7.18 quick ratios. This means that for every 1 ringgit of its current liabilities, the company has 7 ringgit and 80 cents quick assets to cover them. The company is well equipped to pay off its current liabilities promptly. This company is well positioned to meet its short-term obligations without relying heavily on its inventory sales. FCW Holdings has 0.10 total assets turnover ratio. This means that for every 1 ringgit of assets, the company generates 10 cents of sales. This company has a low total turnover ratio, so this means that the company has to explore ways to enhance its revenue generation from existing assets. Then we will move on account receivable turnover. FCW Holdings has 3.47 account receivable turnover ratio. On average, it means that this company collects its account receivable 3 to 4 times over the same period. Next is profit margin on sales. FCW Holdings recorded the percentage of 95% of this ratio. It shows that this company is relatively efficient in converting their sales into profit. For return and common shareholders' equity ratio, FCW Holdings percentage is 9.5%. This shows that this company is able to utilize the funds provided by its shareholders to generate profits. And then debt to assets ratio. This ratio quantifies how much of a company assets are financed by debt, which is the liability, rather than equity. For this ratio, FCW Holdings has 0.03 debt to asset ratio. This means that 3% of its assets are financed by their creditors, while the other remaining 97% is financed by their owner's equity. The last one for FCW Holdings interpretation is debt to equity ratio. FCW Holdings has debt to equity ratio of 0.03. 3% of their financing come from the creditors, while the remaining 97% come from their shareholders' equity.
My name is AQILAH binti HAIRULNIZAM and my matric number is 300668. Okay, now we look at the current ratio of the Eastern and Oriental Company Berhad. The current ratio of the company is 1.76. It means that for every RM 1 ringgit of current liability, the company has RM 1.76 in current assets. It shows that the company has sufficient resources to meet its short-term obligations. For the quick ratio, the company has a quick ratio of 1.08. This means that for every 1 RM 1 ringgit of current liability, the company has 1.08 ringgit in quick assets available to cover it. It indicates that the company has sufficient quick assets to pay for its current liabilities promptly. Now we will look at the total asset turnover. The company Eastern Oriental has a total asset turnover ratio of 0.70. It means that for every ringgit of assets, the company generates 70 cents in sales. The company has a lower total asset turnover ratio. This company may not be using these assets due to excess inventory, underutilized equipment or operational inefficiencies. Account receivable turnover. The company Eastern Oriental's account receivable turnover ratio is 8.64. It means this company on average, the company collects its account receivable approximately 8.64 times over a given period. It shows that the company efficiently collects payments from its customers. Profit margin on sale. The Eastern Oriental Company's percentage stands at 16.53%. It indicates that this company may face challenges in converting sales into profit. The company may have higher operating expenses, increased market pricing pressure, or less efficient operations. On common shareholders equity ratio, the Eastern Oriental Company has percentage of 2.73%. This indicates that the company may be less efficient utilizing the funds provided by its common shareholders to generate profits. For the debt to asset ratio, the company Eastern Oriental has a debt to asset ratio of 0.47. This means that 47% of its assets are financed by creditors, while the remaining 53% are financed by the owner's equity. It shows that the company is less leveraged and has a healthier capital structure. For the debt to equity ratio, the Eastern Oriental Company has a ratio of 0.90. This means that 90% of its financing comes from creditors, while the remaining 10% is from shareholders' equity. It means that the company relies more heavily on debt financing. It can also increase financial risk.
Having truly analyzed and interpreted the financial ratio calculation, we can now derive actionable insight. Let's move forward to discuss specific suggestions aimed at enhancing the company's future performance. Hello, my name is ZULFIKAR. My metric number is 297031. I want to explain about the suggestion performance between both companies. First of all, Eastern and Oriental Bhd stands out with strong liquidity and profitability. There's room for improvement in assets utilization and leverage management. To enhance performance, Eastern and Oriental Bhd should focus on implementing strategies to increase asset turnover, reduce surplus inventory, and bolster cash reserves. Additionally, optimizing inventory management and refining pricing strategies can help boost profit margins. Despite its famous real estate projects and diverse portfolio, Eastern and Oriental Bhd faces challenge in liquidity ratio and operational efficiency, highlighting the need for improvement. On the other hand, FCW Holdings exhibit impressive liquidity and profitability, but could further optimize asset use. To achieve this, FCW Holdings should concentrate on reducing excess inventory, investing in productive assets, and adopting stricter credit requirements, while enhancing client follow-up to manage account receivable more efficiently. Moreover, strategic borrowing could be considered to support growth initiatives without compromising financial stability. In summary, both companies between ENO and FCW Holdings possess strengths that contribute to their success in market. However, addressing inefficiencies in asset utilization, liquidity management, and profit margins will be crucial for sustaining their competitive edge and fostering long-term growth. That's all from me. Thank you.